When payday arrives this month and you check your bank account, how do you feel? The number is clearly higher than last year, yet somehow it doesn't feel as comfortable as it used to. You've been having more and more moments at the grocery checkout thinking, was this always this expensive? But then you turn on the news and the government says this, inflation rate 2.5% being managed stably. 2.5%. Doesn't that feel different from the reality you're experiencing? Today I want to talk about that gap. In economics, this phenomenon is called financial repression. It sounds grand, but it's actually a very old and sophisticated mechanism. And right now, at this very moment, it is quietly at work on your paycheck, your savings account, and your cash. By the end of this video, you'll understand, so that's why I've always felt stretched even though I work so hard. Let's start with a very familiar example. It's about housing. Let's say you bought an apartment worth 300 million won with a fixed-rate loan at 3.5% per year. You'd need to repay about 1.35 million won every month. Now, one question, whether that loan turns out to be good debt or bad debt is determined by how the property price moves going forward. If the property price rises 3.5% every year, the interest you pay and the rise in property value match up perfectly. It's essentially borrowing money for free. If the property price rises 5% per year, after 10 years, tens of millions of won will have accumulated. On the other hand, if the property price rises only 1%, you're paying 3.5% in interest while the property only goes up by 1%, so you're actually losing in real terms. Keep this simple logic in mind. From here, I'm going to apply this exact logic to the US government, and that's where the story changes completely. The US government currently holds debt of approximately $38 trillion, which in Korean won exceeds 50 quadrillion. Korea's annual GDP is about 1,700 trillion won, so US debt is equivalent to everything the entire Korean economy earns over 30 years. The average interest rate on this debt is approximately 3.35%. The interest alone that needs to be paid every year is $1 trillion, about 4 trillion won every single day. For the US to sustain this enormous debt, the real value of that debt needs to quietly melt away little by little. Inflation plays exactly that role. When prices rise, the same amount of debt becomes lighter in real terms. So the most ideal scenario from America's perspective is to sustain inflation continuously at a level similar to or slightly higher than the interest rate. But here is where a problem arises. There is a gap between actual inflation and the figures officially announced by the government. Over the past 30 years, the prices of real assets in the US, such as housing, energy, and food, have risen by an average of approximately 3.37% per year. Yet over the same period, the official CPI rose by 2.53% per year. The difference is 0.84%. Just 0.84%. You might say that, but wait, let's say you have 100 million won in cash. If actual prices rise by 3.37%, the purchasing power of that money 1 year later shrinks to about 96.63 million won. You've lost the equivalent of 3.37 million won. But if the government determines pensions, wages, and welfare benefits based on the official CPI of 2.53%, by the official standard, it's treated as though you only lost 2.53 million won. Where did the remaining 840,000 won go? It was quietly transferred to the government side. It's not collecting taxes through legislation, but rather a structure where wealth is transferred through the gap between statistics and inflation. This is financial repression. So why does the official CPI come out so low? This is not a conspiracy theory. It's a change in statistical methodology. Since 1983, the U.S. Bureau of Labor Statistics has adjusted the CPI calculation method several times. They incorporated assumptions such as substitution effects, where consumers switch to chicken when beef gets expensive, and introduced methods to adjust price increases when quality improvements occur. As these techniques accumulated over decades, the phenomenon where the numbers come out lower than actual felt inflation emerged, according to the observations of numerous economists. Now we need to talk history, because this is not something happening for the first time. When World War II ended in 1945, U.S. national debt was 119% of GDP. That's similar to the current level of U.S. debt. How on earth did the U.S. handle this debt right after the war? Did they raise taxes dramatically? Did they implement austerity? No. The U.S. kept interest rates suppressed at 1 to 2%, while maintaining inflation at a level of 5 to 8%. While the economy grew and prices rose, the real value of the debt quietly melted away. And 25 years later, in 1970, the debt ratio had come down from 119% to 65%. Inflation had dissolved the debt. What about Japan, on the other hand? After the bubble collapse in the 1990s, Japan also pumped money in with low interest rates. But inflation didn't happen. As a result, the real value of the debt did not shrink, and debt kept piling up. Debt that was 70% of GDP has now surpassed 265%. The difference between the two countries was just one thing: whether inflation existed or not. Can you understand a little now why America doesn't try to eliminate inflation entirely? But there's one more pattern worth noticing: the 2008 financial crisis. The Fed injected over $2 trillion. The 2020 pandemic, nearly $3 trillion was injected again. The result was the sharp price surge of 2021 to 2023. Do you see it? A crisis occurs roughly every 10 years, and each time a massive amount of money gets pumped in. Why every 10 years? The standard U.S. home mortgage cycle is 10 to 15 years. If rates stay high for too long, consumers begin to take a serious hit at this point, and the economy cools sharply. As a result, a cycle repeats where a crisis appears every decade. The Fed steps in and injects money, asset prices rise, and inflation quietly creeps up. The Fed's assets were $900 billion in 2007 and are now approximately $7 trillion. They grew nearly eightfold in 15 years. Now let's come to the present. T-bill rate 5.2%. T-bills are short-term bonds issued by the U.S. government. Simply put, they're like a deposit where you lend money to the U.S. government briefly and get it back within a year. The interest rate on that is currently 5.2%. If the official CPI is 2.6% and the T-bill rate is 5.2%, simple math gives a real interest rate of 2.6%. But then why are market participants buying these bonds? Because the market is sensing that actual price increases are higher than the official CPI. If you view actual inflation as 3.37%, subtracting it from 5.2% gives a real return of about 1.8%. In other words, the T-bill rate itself can indirectly reveal how the market actually perceives inflation. And the U.S. government has recently been rapidly increasing short-term bond issuance. It went from 17% of GDP in 2021 to over 22% in 2024. When supply increases, interest rates go up. So how long can this system continue? The first signal economists are watching: if the T-bill rate consistently surpasses 6%, it could be a signal that the actual inflation the market is sensing has far exceeded the official figures. Second, if the 10-year U.S. Treasury yield consistently surpasses 5%, it could mean international investors have started to trust U.S. Treasuries less than before. Third, if the dollar's share of settlements falls from the current 55% to below 50%, interpretations may emerge that a meaningful change in reserve currency status is beginning. Some of you may be thinking of the 1970s. Back then, too, as trust in the dollar wavered, the suspension of gold convertibility, a spike in interest rates, and high inflation hit in succession. Of course, the U.S. economy survived afterward. But in that process, a large gap formed between those who couldn't respond and those who were prepared. We've now seen the gap between official CPI and actual prices and how that 0.84% operates like a quiet tax. But here one more uncomfortable question arises. Is the gap really just 0.84%? From here, we'll dig a little deeper into that number. MIT's economics department has been running the Billion Prices project since 2008, tracking approximately 1 million online prices worldwide in real time. What this project repeatedly confirmed was one thing: official CPI fails to reflect a significant portion of actual price increases. The gap was especially large for core life costs like housing, healthcare, and education. Former U.S. statistician John Williams has been publishing shadow stats for decades, recalculating CPI using methods from before the 1980s. According to his estimates, between 2008 and 2018, actual price increases may have averaged 6 to 8% annually during a period when official announcements were showing 1 to 2%. There are counter-arguments to these figures, and the debate continues today. But that a gap exists, and that the direction consistently shows actual being higher, is repeatedly confirmed across multiple independent studies. If the gap is 5% per year, running compound calculations over 10 years, the real purchasing power of 100 million won in cash becomes approximately 59.87 million won. The number in your bank account stays the same, but over 40% of purchasing power has disappeared. When you apply this to the scale of national debt, the story changes completely. IMF economist Carmen Reinhart called this mechanism the quiet liquidation of government debt in a 2015 paper. It's a structure where inflation dissolves the debt. Those who end up in an advantageous position from this gap are broadly three groups: the government, whose debt shrinks in real value, asset holders whose nominal asset prices rise, and institutional investors who have taken out large loans at fixed low interest rates. On the other hand, those placed in a disadvantageous position are people holding only cash and deposits and developing nations that have lent out dollar-denominated assets. This is not someone's intention, but rather the result that the structure produces. Right after the 2008 financial crisis in the U.S., hundreds of thousands of homes were foreclosed and flooded the market. The ones buying these homes were mostly not individuals. Large institutional investors like BlackRock and Invitation Homes purchased them in bulk at an average price of around $150,000. In 2008, the share of U.S. single-family homes owned by institutional investors was 1 to 2%. By 2024, it had exceeded 20%. In 16 years, 1 in 5 U.S. homes became institutionally owned. A pattern is visible in this timing. Right after institutional investors finished their bulk purchases, the Fed began quantitative easing and zero interest rates in earnest. Thanks to low rates, loan interest costs were minimized. Thanks to inflation, rental income steadily rose, and asset prices nearly doubled over 10 years. It was a decade where low rates and inflation simultaneously worked in favor of asset holders. Whether this was intentional design is unknown. However, the fact that the direction was consistently that way is true. This is why such interpretations emerge. Behind low-rate policies, beyond stimulating the ordinary economy, structural pressure to maintain the profitability of institutions holding large-scale assets may be operating simultaneously. Because when rates are low, interest costs are low, and as inflation rises, rental income goes up too. This is not an assertion, but an interpretation readable from the pattern. If that's the case, the timing of the return to low rates also needs rethinking. JP Morgan CEO Jamie Dimon said in the high-rate environment of 2022, high interest rates cannot persist for a long period. This may not have been just a statement for economic stimulus. If the interest costs on large-scale assets held by institutional investors begin to exceed rental income, the pressure to want low rates inevitably grows. There's one more structural reason here. Variable rate mortgages issued in the U.S. between 2012 and 2019 amount to approximately $2 to $3 trillion. These loans have a structure where rates are recalculated around the 10-year mark. People who borrowed at 3 to 4% during the low-rate era begin getting recalculated at 7 to 8% from 2024 onward. Monthly payments for approximately 3 to 4 million households increase by 30 to 50%. As this pressure accumulates, the economy cools, and the Fed must eventually make a choice. Now let's look at the high interest rate phase. A pattern appears clearly in the high rate cycle that has continued since 2022. When U.S. rates rise, the dollar strengthens. When the dollar strengthens, the currencies of developing nations with dollar-denominated debt weaken. The Korean won has weakened by about 30% since 2022, the Turkish lira by over 50%, and the Argentine peso has collapsed by nearly 80%. When exchange rates collapse, real estate, companies, and resources in developing nations suddenly become half price for those holding dollars. Collect internal assets with low rates, collect external assets from developing nations with high rates. This cycle has repeated roughly every 10 to 15 years. The 1997 Asian financial crisis is a representative example. At the time, U.S. interest rate hikes served as the trigger, and as exchange rates collapsed, prime assets from Korea and other Asian nations were sold off at bargain prices. Of course, you can't definitively say all of this is precisely engineered. The economy isn't that simple, and there are always unintended variables. But the fact that this kind of structure has repeated as a result, and that the advantageous and disadvantageous positions have consistently been on the same sides, is true. Recognizing the pattern, that's the starting point. So will the dollar last forever? No, but it's also hard to say it will end soon. Historically, replacing a reserve currency has taken decades. It took about 50 years to transition from the Dutch guilder to the British pound, and it also took about 50 years to move from the pound to the dollar. The dollar has been dominant since 1944, currently about 80 years. By historical standards, it's still middle-aged. The yuan, currently cited as the dollar's competitor, holds about 4% of international settlements. The dollar holds about 47%. The gap is still overwhelming. Alternative payment systems like mBridge and SIPS are growing rapidly, but they are far too small in scale to replace the world's entire financial infrastructure. The dollar's reserve currency share has fallen from 72% in 2001 to 55% in 2024. It's declining, but declining slowly. The real reason the dollar keeps working may not be because it's strong, but because an alternative hasn't been completed yet. A cycle of dissolving debt with inflation, collecting internal assets with low rates, shaking developing nations with high rates, and returning to low rates again. As long as this structure continues without an alternative, the dollar functions as a repeatable system even while appearing to weaken. If today's conversation were to be summarized in one sentence, it would be this: the dollar rides cycles like a real estate investor. Buy with low rates, grow with inflation, shake the outside with high rates, return to low rates again. While this cycle repeats, the cost is quietly shared by those holding cash in developing nations that lent in dollars. Intended or not, the result is consistent. What I wanted to give you through this series was just one thing: inflation, interest rates, exchange rates, that these numbers aren't just background noise in economic news, but are structures actually connected to your bank balance, your purchasing power, and your assets. No grand conclusion is necessary. The moment this structure becomes visible, the way you read the news changes. Finally, I'd like to ask you one thing. In this current cycle, where do you feel you are standing? Are you on the side holding cash or on the side holding assets? If you share your thoughts in the comments, it will be a great help in deciding the topic for the next video. Thank you sincerely for spending this long time with me.